This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Will April showers give way to May flowers on Wall Street? We have predictions from the market pros.
Twitter tumbles, quarterly results disappoint. Why? And what's the one key takeaway for investors?
And safer shopping, the big move Target is making to secure its payment pipeline in the wake of the massive data breach late last year. We have all that and more tonight on Nightly Business Report for Tuesday, April 29th.
Good evening, everyone, and welcome. With just one more trading day left in the month, Wall Street looks to be wrapping up a very volatile April with a big push to the upside. And it got help from another round of better-than-expected corporate earnings. Upbeat quarterlies before the bell from companies as diverse as the drug maker Merck, engine maker Cummins, Ameriprise Financial, and the telecom giant Sprint all helped the major averages climb higher today, with the Dow and the S&P now within striking distance of all-time highs. Today on Wall Street, the Dow was up 86 points, the Nasdaq was higher by 29, and the S&P added nearly 9.
But earnings late today from eBay and Twitter could set a negative tone tomorrow when the opening bell sounds. First, eBay. It posted better than expected quarterly profits, but it issued a disappointing outlook, and shares fell as much as 4% in after-hours trading. As for Twitter, profits beat estimates, but when you take out one-time charges, but they weren't big, less than a penny a share. Quarterly revenue more than doubled to $250 million and beat analyst estimates. But Twitter shares sold off in after-hours trading, down almost 10%, but during the regular session, they were up nearly 5%. Seema Modi has more on Twitter's numbers and the one big takeaway for investors.
Investors were hoping for a blowout number when it comes to user growth, but that's not what Twitter essentially delivered. 255 million monthly active users, up only 5.8% from the previous quarter. Analysts were expecting a higher number. Now, slowing growth concerns have kept a lid on shares of Twitter, which are down about 40% just this year. The weaker than expected number does come ahead of Twitter's lockup expiration of nearly 500 million shares on May 5th, when traders are concerned that insiders will sell shares. For Nightly Business Report, I'm Seema Modi from the New York Stock Exchange.
And as investors look to tomorrow and as the up and down month of April draws to a close, Dominic Chu takes a closer look at whether April showers may give way to brighter days ahead in May and maybe even beyond.
For many investors, April will be a month they'll soon want to forget. A lot of the stocks that made investors a lot of money over the past couple of years took the biggest beating this month. Think about social media stocks like Facebook and Twitter, or online video streaming company Netflix, even the world's biggest internet retailer, Amazon.com.
We think that some of the high flyers, which have come down, are still at very lofty valuations and hard to really justify. We contrast that with other kind of old technology dinosaurs like Microsoft, Cisco, Hewlett-Packard, where their actual results have been quite good and their valuations are very attractive.
Of course, the big question facing a lot of investors is whether or not the coming summer months will generate more market pain. Traders have an old saying, sell in May and go away. And there's a reason why. According to S&P Capital IQ chief U.S. equity strategist Sam Stovall, since World War II, the S&P 500 recorded its strongest performance between the months of November through April, gains of around 7% on average. Meanwhile, the months of May through October generated gains of just a little over 1%. Some experts are saying to expect stock market volatility in the coming months.
I think we're in the middle of a transition. I think transitions are clunky. We're going from a market that's been driven by monetary policy into one that's going to eventually transition into more fundamentals. Of course, earnings always matter. So volatility is here to stay, I think, for this year.
The bulls will say that stocks still remain near record highs. The bears will say that we're long due for a significant pullback. Regardless, it may be worth keeping your seatbelt buckled, even if you don't think you'll need it. For Nightly Business Report, I'm Dominic Chu.
Our guest tonight is one of those bulls. Nick Colas is Chief Market Strategist at Convergex. Nick, nice to have you with us.
Thanks so much.
me just first start by asking you about eBay and Twitter, because their stocks have been down sharply in after-hours trading. I mean, what impact could something like this have on trading tomorrow and investor confidence?
Well, I'll tell you, over the short term, it can be a little bit damaging because a lot of folks have made very good money in all the momentum names that we've seen rally, in some cases 100% and more over the course of the past year. But underlying market fundamentals are more important. So what the entire economy does and what corporate profits do in general, thankfully, over the medium and long term is more important.
Do you think these two companies are healthy? I'm not asking you to recommend the stocks, but
Sure.
Is there anything in those reports that leads you to believe that they're not?
No, I'll tell you, the bottom line with any of these stocks is investors are drawn to them because they have very interesting long-term potential and very good near-term fundamentals. It always comes down to valuation, and that's where it gets very tricky. You can be very enthusiastic about a company and still not buy the stock because you think the valuation's too high.
Mm-hmm. You said a moment ago, Nick, that it's going to be the economy that is the real driver here. But the U.S. economy has, been kind of anemic, really, for a while. This recovery has been subpar. So what is going to be the catalyst in the economy that will then be a catalyst for the stock market?
Yeah, it's a great point. The bottom line here is that corporate profitability is extremely high, even though we've had that very lackluster recovery. And if you want to be bullish on stocks, you've got to believe that the economy can recover modestly but progressively over the balance of the year, and that'll provide incremental profitability to these companies that already have very good cost structures.
Nick, as we enter May, beginning later this week, and then the summertime, that is seasonally a time when the market sometimes stumbles, at least over the past few years. Some of our roughest months have been those summer months. What are you expecting over the next 3 to 6 months?
Over the next few months, I do think we'll see some volatility, but we're still fairly bullish about equities. It'll be important to take the longer view as we get that volatility and really focus on incremental growth in jobs, incremental growth in things like automobile sales that are very indicative of the economy as a whole, and in general the health of the consumer as we think about the next half of the year.
All right, so any advice you have for investors of what to do with their portfolios over these next couple of months that could be kind of volatile?
Absolutely. The key here is you've got to diversify and stay diversified. For example, bonds were really out of favor at the beginning of the year, and they've actually kept pace with stocks all the way through the end of April, all the way where we are right now, even though people really didn't like them very much. So the key is to keep a focus on the long term, stay diversified, and use volatility as opportunity to perhaps buy a little bit more rather than try to bail on the market and try to time it. Very difficult game to do.
Do you like bonds here at these levels? If the economy heats up, as some people believe, you would think that interest rates might rise.
Yeah, I'll tell you, bonds have been the surprise story of 2014, and they've had an impressive rally. I would say that there is still sufficient concern about things like macro issues, for example, oil prices and the problems between Russia and Ukraine, that would keep us wanting to still keep a portion of a portfolio in bonds just in case.
And we've seen utilities doing phenomenally. What do you think about utilities? Is that still another safe place to park your money?
So utilities have been amazing this year, up 11%. They've beaten the pants off of most hedge funds that invest in the U.S. market. So utilities are still a good place to be. They might be for the classic widows and orphans portfolio, but they've had a robust performance and still a winning group.
All right, Nick, thank you so much for coming by and talking with us. Really appreciate it.
Thank you.
Nick Colas with Convergex.
Well, mixed news in housing to tell you about. The Commerce Department says home ownership in the U.S. fell during the first quarter of the year to just 65%. That's the lowest level overall in nearly 2 decades. Part of the problem, home prices are too high for many would-be buyers, especially the first-timers. Just today, the Case-Shiller Home Price Index for February reported a 12% increase in prices in the nation's biggest cities year over year, but prices barely budged from the prior month.
And the people who help guide the interest rates on home mortgages, the Federal Reserve policymakers, began a 2-day meeting today in Washington. No change is expected in the Fed's key interest rate, but the central bankers are expected to reduce their bond-buying stimulus plans by another $10 billion a month.
It looks like General Electric may have a deal. The board of directors at the French engineering group Alstom has reportedly accepted GE's more than $12 billion offer to acquire its energy business. An announcement could come on Wednesday, but before it's a done deal, industrial giant Siemens said it would make an offer to buy Alstom if it's given enough time to go over that company's books.
Apple returned to the bond market today, and investors are eating it up. The tech giant put $12 billion worth of corporate debt up for sale, which is higher than the $8 to $10 billion expected. Maturities range from 3 years all the way to 30 years. And to show how big demand is, investors reportedly put in orders for more than $40 billion in bonds.
More now on those strong earnings from Merck. Merck, biggest gainer in the Dow today, rising almost 4% after first quarter profit jumped 7%, helped by aggressive cost cutting. Sales of Merck's top sellers, type 2 diabetes pills were higher, but overall pharmaceutical sales fell 5% because of competition from rival generic versions of other drugs.
Target is going all out to improve data security for its credit card users. The discount chain is starting with a new management and more secure type of credit card. Mary Thompson explains.
Red, white, and still bruised from last year's massive data breach, Target plans to better protect its customers with a new type of card.
Target has to move quickly to ensure they've got the most up-to-date standards and security for their purchaser base.
Target plans to adopt MasterCard's chip and PIN technology for its 23 million member Red Card portfolio by early 2015. This means all Red Card debit and credit cards will carry a customer's information on an embedded computer chip rather than on the magnetic stripe found on the back of most U.S. credit cards. Known as EMV technology, these chip-enabled cards cut fraud as they're harder to counterfeit. Overseeing this effort, outsider Bob DeRhodes, who's worked in the Departments of Defense, Homeland Security, and Justice. He's Target's new Chief Information Officer. The Minneapolis-based firm is the first major U.S. retailer to adopt EMV technology, a technology payment processors Visa and MasterCard want as the standard by October of 2015. At that time, liability for fraudulent transactions for card-present transactions, meaning those made in a store, will fall to the weakest link of the payments chain. The threat of having to cover the costs of potential fraud expected to spur retailers to buy new chip and PIN terminals that are needed to process payments on the more secure EMV cards. While its adoption will be a big step in reducing credit card fraud, analyst Thad Peterson says EMV won't prevent fraud within the system. That's prevented by tokenization, which essentially scrambles a customer's information so it's harder for a thief to steal.
When the information is being transmitted across the system from say, the merchant to the card issuer for payment, there's no way for that to be broken.
Tokenization and chip-enabled cards, both key to securing the payment pipeline. For Nightly Business Report, I'm Mary Thompson.
Still ahead, you're saving more for retirement. That's the good news. But is it enough? Details of a new Fidelity study and what you can do to make sure the golden years stay golden. Last night, we told you about the growing list of big-name advertisers and sponsors suspending or terminating deals with the NBA's Los Angeles Clippers over racist comments made by the team's owner, Donald Sterling. Today, it was league officials at the National Basketball Association coming down very hard on Sterling. He has been banned for life from attending any NBA games, practices, or other events, and was fined $2.5 million. NBA Commissioner Adam Silver also is urging other team owners to force Sterling to sell the team.
A big power company from Texas has filed for bankruptcy. Dallas-based Energy Future Holdings, once known as TXU Corp., was facing more than $100 million in debt payments for this week. Payments it will not be able to make. But filing for bankruptcy protection lets the private equity-owned utility to negotiate with creditors as it restructures its business.
An update now on a potential deal. We told you about this one in the pharmaceutical industry, where so many deals have been taking place lately. Botox maker Allergan looks to be trying just about anything to avoid being acquired by hedge fund billionaire Bill Ackman and his partner, the Canadian drug maker Valeant, for $46 billion. Allergan has reportedly approached Johnson & Johnson, the French drug company Sanofi, the UK's Shire plc, and other firms to gauge their interest in buying the company.
Shares of Coach plunged after the retailer reported quarterly profits, and that's where we begin tonight's market focus. Earnings at the luxury retailer tumbled 20%. The handbag and accessories retailer said its North American sales fell due to tough competition. That sharp drop in sales sent the stock down more than 9% to $45.71. Bristol-Myers Squibb reported better than expected quarterly earnings, helped by cost cuts and lower taxes. But revenues missed estimates and shares fell on concerns over a possible delay in completing a marketing application for its high-profile cancer drug. Bristol fell 2% to $49.32.
Goodyear Tire reported an earnings miss on the top and bottom lines. The biggest U.S. tire maker was hurt by severe weather in North America, and a labor dispute in Venezuela also took a $132 million charge related to a drop in the value of Venezuela's currency. Shares tumbled 7.5% to $25.11. IBM's board approved a 16% increase in its quarterly dividend, which is now $1.10 a share. That will be paid to stockholders in June. This is the 19th year in a row that the company will up the return. Shares of Big Blue up 1% to $195.11.
The stock market is doing better since the financial crisis, but it's taking a bit longer for America's retirement prospects to get back on track. Fidelity Investments, the nation's largest provider of retirement plans, revealed today some positive results for millions of Americans in the 5 years since the market downturn. But as Sharon Epperson reports, there's still plenty of room for improvement.
A surging stock market has helped the recovery of many workers' retirement plans over the past few years. New data from Fidelity, the nation's leading 401k provider, shows an impressive 92% gain in the average 401k account balance since the market low of the economic downturn in 2009. By the end of the first quarter of this year, the average 401k was worth $88,600, up from $46,000 5 years ago.
About 3/4 of the account balance growth has been due to the market, and about 25% or a quarter was due to employees putting more money into their 401k plan. When we look over a 10-year period, what we find is that 50% is due to the market growth, and 50% is due to employee and employer contributions. And so what that really drives home is that it's really important over the long term not only to put money into your 401k, but also to make sure that you're invested appropriately for your age.
Despite market gains, most workers still don't have enough money for retirement. A married couple retiring at 65 may need as much as $360,000 in savings, more than 4 times the average 401k balance today. But most workers have no idea how much money they'll need in retirement.
Only 4 in 10 workers are using retirement savings calculators, and that's important because that means the majority are still guessing and don't really understand how much they need to save for retirement.
They may not be saving at all. Fidelity found that almost 1/3 of workers who have access to a 401k plan are not contributing, and those who are offered a matching contribution from their employer may not take advantage of it. Fidelity found workers save about 8% of their pay in 401k on average. But financial experts say for most workers, that amount is less than what's needed to ensure a comfortable retirement.
We really recommend to get to, to replace a good amount of your income in retirement that you save 10 to 15%. And we understand that in the beginning when you're young and you're just starting out, you may not be able to start out at 10 or 15%. So you start out where you can, and then every year we recommend increasing that annually.
The first step, no matter what age, is to figure out where you stand right now.
No savings plan is going to be implemented without a really honest assessment and a look at how I'm spending money, where I spend money, and more than likely making some changes in how spending patterns occur in order to free up the capacity for savings.
The solution is simple, but takes discipline. For Nightly Business Report, I'm Sharon Epperson.
To read more about Fidelity's study and what you can do to keep your retirement on track, go to our website, nbr.com. And still ahead on the program, the most influential businessman of the past 25 years. His vision and passion transformed industries and changed consumer buying habits. That's next.
Today, in connection with its 25th anniversary, CNBC, which produces this program, announced its list of the top 25 people who left the greatest marks on business, finance, the markets, and consumer culture over the past quarter century. And here are the top 5. Number 5, Amazon.com founder Jeff Bezos. At number 4, the Google guys, founders Larry Page and Sergey Brin, plus the CEO who pulled it all together, Eric Schmidt. Number 3, the controversial U.S. central bankers whose actions were, well, central to almost everything, Alan Greenspan and Ben Bernanke. Number 2, Bill Gates, the geek who more than anyone put a computer on every desk. And topping the list, the geek who made computers chic, Apple's Steve Jobs. Pioneer, innovator, tastemaker, genius. Steve Jobs transformed the way we think about technology and the Apple. Walter Isaacson is Jobs' biographer.
Steve Jobs is sort of the American creation myth writ large. He started a company in his parents' garage with the chubby kid from down the street, and he turned it into the most valuable company in the history of the world.
Growing up in Silicon Valley, Jobs became the oddest fusion of California's engineering and hippie cultures. He wasn't a programmer so much as a marketer and dreamer whose big idea was to sell his friend Steve Wozniak's creations.
He was smart enough to know that he needed Steve Wozniak and others who were much better software engineers or hardware engineers. But what he's able to do is bring everything together into a package and then figure out how to build a business around it.
And what a business he built. More than anyone, Jobs put the personal into personal computers, creating elegant machines that sometimes looked like a toy and, often as not, were as admirably easy to use as one.
Technology was barreling along in the mid-70s when he starts Apple, but he's the one who said, let's make it intuitive and simple and beautiful. He connects art to technology.
But his demeanor and managerial style was not as simple.
I've talked to people close to him about his managerial style. Yes, he was passionate. Yes, he could be sharp with people, but he also recognized talent, and he passionately believed in the quality of the products that Apple was going to create.
The personality of Steve Jobs was somebody who believed that the ordinary rules didn't apply to him. He was special. He could distort reality and make things happen.
Eventually, though, after a 1985 power struggle with his hand-picked CEO John Sculley and the Apple board, Jobs left the company he started.
After Steve gets ousted from Apple, he formed his own computer company called Next, where he really indulges his passion for perfection. And what he learns is you have to make some trade-offs, because it wasn't very successful in the marketplace.
But he's got this incredible drama of being kicked out of his own company, going off into Pixar, which was a scrappy little animation studio he got from George Lucas, turning it into a blockbuster business, and then coming back to Apple, riding in and saving the business.
The year was 1997.
He says focus. He cuts out all sorts of product lines. And he says we're going to simply do a desktop and a laptop for the home and for the office.
But Jobs' focus wasn't just on desktops and laptops. He loved music, Dylan, the Beatles. He wanted to carry them with him. It was 2001.
He launches something that nobody expects, which is the iPod, and it sort of changes the music industry just like he had changed the home computer industry.
The iPod led to another Jobs innovation.
And we are calling it iPhone.
One of the interesting things about the iPhone is that everybody at Apple knew it would cannibalize the iPod. The iPod was very successful, but Steve Jobs started worrying about what could go wrong. And he said, well, if the brain-dead people who make cell phones learn to put music on cell phones, that will hurt the iPod. So we have to cannibalize ourselves before somebody else eats our lunch.
Jobs wasn't done. If anything, a 2003 diagnosis of pancreatic cancer quickened his restless pace of innovation.
I think people were puzzled, in the years of 2000 to 2010, about why Steve Jobs kept going into different industries. But it totally transforms what our view of the phone is. And then he does it again with the tablet. People had made tablets before. Nobody expected Apple suddenly to do it.
Some call him a retail genius on a par with Sam Walton,
the App Store, iTunes, those sleek, stylish branded outlets.
That full 360-degree immersive experience in Apple's world really caught the consumer's imagination. And Steve Jobs, at least as far as business is concerned, became larger than life right around then.
In August 2011, he stepped down as Apple CEO. 6 weeks later, he was dead.
I think a generation from now, in fact a century from now, Steve Jobs is the person we're going to most remember as being the epitome of the business in the digital age. The personal and home computer industry, the music industry, the digital animation and retail stores, publishing, tablet computing, over and over again, he's a disruptor, and he's the one we're going to remember a long time from now.
So how was the list put together? What was the thinking behind the rankings? What were you thinking? To get the full list and read more about CNBC's First 25, head to our website at nbr.com.
I don't think anybody would argue with the Steve Jobs choice, but was there anybody you think that should have been on the list but just didn't make it?
I thought Michael Dell should have made the list of 25 because he was an industrial revolutionary who invented the sort of just-in-time manufacturing for you.
Direct
of the laptop.
marketing.
Direct marketing.
All right. Great list. Great
Thank
job,
you.
Tyler. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for watching.
And I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody. We'll see you back here tomorrow night.
I'm Susie Garrett with a Nightly Business Report news brief. Here's something to tweet about. Ad sales at Twitter more than doubled over the past 3 months, but user growth wasn't so strong. Twitter stock tumbled in late trading. That could set the trading tone for Wall Street tomorrow. But today, stocks rose on upbeat earnings. The Dow gained 86 points, the Nasdaq was up 29, and the S&P added nearly 9 points. Mixed news on housing. Home ownership fell during the first quarter of the year to just 65%. That's the lowest level in nearly 2 decades, while home prices in February rose 12% year over year in the nation's biggest cities. And reportedly, General Electric has gotten the okay to buy the energy business from French engineering group Alstom for $12 billion. Be sure to tune into Nightly Business Report right here on your public television station.